So 361 Firm is a platform for investors, family offices by heritage, but more and more institutional and some high net worth, to collaborate on investing in philanthropy. We typically do that with funds. In fact, one fund, we even created a fund called 361 Ohio Tech, which is invested in an indirect and soon direct investor into one of the companies. So we, in all disclosure, either this Zoom or other Zooms, we will have our clients, but we do ask them, if you could show the third slide, Paul, to not to do two things. One is not to pitch. That's for both.
Yes, I'm on.
Okay, good. But not to pitch for a couple of reasons. One, I think people are not listening as effectively. We want to teach each other things. So there's a lot of unique insights that these panelists will share. Paul Mangione is a fellow banker, partner of mine, and leading this in this domain. So I'm glad to hand it over to you, Paul, to facilitate this. I think this will be one of several. There are many asset classes that are being tokenized and fractionalized. So, I think this will be a good kickoff for the subject for multiple events. So with that, Paul, I'll hand it over to you.
Great. Thank you, Mark. Good morning, everyone. Good afternoon. My name is Paul Mangione. I'm a founder of Fort Schuyler Capital. Just one word on Fort Schuyler Capital. So we focus on all aspects of structured finance opportunities for originators and investors. We do capital markets advisory for, structured finance and whole loans. So that's just a little background on me. We have, three, very interesting panelists. I think we're gonna track Mohsen down in a second, but Mohsen Masood, he's the CEO and founder of Accrue. We have Samuel Grossman. He is the managing director of Invenium, and he'll give a background on that, but it's a very interesting data, real-time data platform for supporting the blockchain and private capital markets. And Sid is the founder and CEO of Intane, a blockchain structured finance firm, really focused around administration and capital markets now for the structured finance markets. So why don't I give Sam a second and Sid an instant. So Sam, why don't you introduce yourself and give us a little more of your background?
Absolutely. Thank you, Paul. Happy to join everyone today. I'm the managing director of real estate solutions here at Invenium. Invenium's the data operating system for private market assets. We basically provide a real-time due diligence room for a multifamily or any asset class. What we do is we aggregate the data, extract it, we credential it and anchor it to the blockchain for asset owners. Then we provide real-time valuation as well. We really just provide better data, which creates better value, which allows you to make better decisions and puts you on the path to tokenization, while also anchoring all of your data to the blockchain, which provides transparency.
Great.
So,
thanks, Sam. And Sid, why don't you give a little overview of yourself and Intane?
Hi, thanks, Paul. Good to be with this group. Siddharth, founder and CEO of Intane. My background is financial services, operations, middle back office, Deutsche Bank, State Street. Founded Intane 2018. For the last 4 or 5 years, we have been building and running the administration and servicing infrastructure for asset and mortgage-backed securities. And now we are launching a marketplace where you can actually issue and invest in mortgage and asset-backed securities.
Thanks, Sid. And Mohsen, I see you've joined us. Thank you so much. Please introduce yourself.
Yeah, my name is Mohsen Masood. I am the founder and CEO for Accrue. Accrue is a platform for fractionalizing commercial real estate. What I like to say is we slice and dice commercial real estate into $1,000 shares so it becomes more tradable. We work with Invenium to ensure that we have better data for people to make better decisions, and we enable asset owners to get liquidity on the platform.
Great, thanks, Mohsen. So again, we're all here talking about this for educational purposes. We're really here to teach, learn about learn about tokenization, and then really get into some of the content that these experts can share with us. So looking at the list of attendees, we've got a lot of attendees, and one of the ideas, we have a lot of people really skilled with capital markets, really knowledgeable. A lot of them probably have heard about tokenization and are maybe looking at applying tokenization to their businesses. So I guess, the real question let's start with a fundamental question. What is tokenization when we're talking about real estate and structured finance? We've all heard of DeFi, we've heard of the blockchain, but, let's talk about tokenization. Why don't maybe each of the panelists give their view in their specific area?
Happy to go first. So,
Sure.
Real estate tokenization, it's just another fancy word for real estate fractionalization, which has been happening for thousands of years. The only difference is this time around, we're enabling liquidity, right? And we're improving the existing structures around it. If you look at the history in fractionalized real estate, you could go back to just a few siblings owning a piece of land together to what ended up leading to the Harvey test, right? The Harvey citrus grows and the Harvey investments, eventually leading to making REITs, then the Jobs Act. You also had TICs in the middle, followed by crowdfunding really picking up steam, and then Reg A plus becoming another way to raise money. Now, what blockchain does is blockchain really streamlines that process if it's done appropriately, provided that you're really ensuring that the transaction, it adds the efficiency in the transaction, and it ensures that you're recording it over on an immutable ledger, right? So legally looking at it, all that real estate tokenization in today's world is doing is we're just digitizing the Schedule A for an operating agreement, right? That's all that we're doing. We're making sure that the list of the membership interest units is recorded in a digital form, which enables the liquidity within the system, and it can be tracked in such an efficient manner that it can be implemented at scale as well.
Got it. Okay, and Sid, why don't you give us some details? We'll go to the next question. What are the underlying technologies that support tokenization? We've all heard of blockchain. We've heard of Bitcoin. Some of us, have been involved in that, and Ethereum. But what's the underlying technology? Like, this is not a centralized database. This is not a bunch of files in a or PDFs on someone's screen somewhere. This is something different.
Yeah. So for people in capital markets, the way I would look at it is that you have multiple entities running of different databases, and we have armies doing reconciliations. Means in my past life, I was running a 15,000 people operation, 5,000 would have been in recons. Right? So you're just reconciling database. Blockchain ensures almost in a way that everybody's ledger is being auto-reconciled, and as Mohsen said, it's immutable. So you're basically taking an asset, making fractional units of it, which means has been done through shares, etc., for decades. Those fractional units are digital, and they are recorded on an immutable ledger. There are multiple protocols. Ethereum is the most common, widely used. There are what are called level 2 derivatives of Ethereum. But we have many others like Solana, Avalanche, something that we use. There are some private blockchains as well, and we can get into details of some of those.
Great. And Sam, in terms of the use of data with blockchains, like how do you see some of the things that you're involved in terms of real-time data for private markets? Like how has that kind of become part of, how does that support tokenization and blockchain?
Well, it's really the pipes. We see ourselves as at the pipes of the ecosystem. You have the pipes which flow the data and the value, and it's not just about having data. We don't monetize data. We don't take your data. What we really do is just verify each asset owner's data, making sure it's the golden copy, meaning that it's the original document that has not been manipulated. And that's sort of the verification of the data is where it all begins. Once you have better data, then you can automate the process in bringing in a third-party valuation provider to provide real data. The idea that blockchain and Bitcoin are related is sort of a fallacy, in that tokenization is not crypto. It's a very important differentiation to make. The reason why there's so much volatility in the crypto market is because there's no underlying data. There's no underlying asset. There is no true third party that's putting out, this is the value based on this. That is why it's important to know that difference, because when you go to tokenize real assets, tangible assets, buildings you can touch, and the value is then set by a third party versus someone who is a market maker or is getting paid based on the value, right? Then you just have a more consistent, fluent, frictionless process in order to transact. That increase in transactions creates increase in liquidity, which again should create more liquidity in the marketplace and more transactions overall.
Got it. And like Sid, you were talking about, first of all, anyone out there, we're going to have a Q&A. My email's in the chat, or you could just put a question into the chat. So at the end of this, we'll have a couple of minutes for questions. So please have the questions. You can put them in there, and we'll try to get to them during the panel. But Sid, question 3 I put in there is like, what are the benefits of tokenization? You had talked about in your past life, having a couple thousand people, and you had it was like 5,000 people, I think you said, like, that were just kind of reviewing analysis and records. So obviously tokenization must benefit in cost savings from a labor standpoint, and just continually checking and rechecking things. So obviously that's a benefit. Maybe you can touch a little more of that, and then how do people really get comfortable with it? From how do we know what, I think we know what the benefit is. It's time and money are saved, but how do we get, I guess, people comfortable with the tech to really reap those benefits?
Yeah, so tokenization is kind of one outcome of putting an asset on blockchain, but it's taking structured finance as an example. The thing there is the loan originator, the issuer, a custodian, rating agency, the underwriter, servicer, trustee, investor. These are number of parties who are running their own systems, own databases, shipping data to each other on Excel sheets, on emails, then doing ping pongs to reconcile, to establish what the data is.
I mean, what's the real dollar savings do you think? And I mean, obviously the application, but what kind of improvements have you seen, either in your practice,
in our space,
clients?
Yeah. So in our space, we see costs dropping from about 150 bips to 50 bips of a transaction. We have seen there are some intermediaries who have come to us with a proposition on sharing 50% of their fees with our platform. Now, if somebody is offering to share 50% of their fees, means their costs are reducing by 80 to 90%. So that is the level of transactional cost reductions that could be achieved in some asset classes.
Great. So I'm going to bring in, I got a question here I think is interesting. It's really, what is the current institutional adoption of tokenized real estate platforms? So maybe Mohsen, you can kind of, give.
Yeah, so I want to quickly touch on the
Sure.
previous question as well, right? So when you talk about the benefits of tokenization, benefits of tokenization lead to the efficiencies within the transaction, the settlement periods, the recording of the ledger on the recording of the transaction on an immutable ledger. It's a distributed ledger where you're just recording transactions. You're not putting data on there, right? So you should really look at also how it's really you're creating this perfect trail and transparency within that ownership structure as well. You're able to create and track ownership down to a 15th of a second based on that information. And then when the data piece is connected through to it and the secondary market transactions start happening, that really leads to the true efficiencies that get brought in by reducing the need, as Sid was talking about, the TAs involved in the entire system, the efficiencies get introduced by reducing reducing the hurdles between the communications, and everyone else's database is running, everyone having different pieces on it. So it streamlines the entire piece to it. Your second question on the institutional asset adoption on real estate tokenization, yes. That's something that's growing, right? So our last year was all about educating people more and more on how real estate tokenization works. That's a cruise very, very focused on the core assets, which are stabilized income producing assets, which are growing into the larger institutional asset schemes, right? Last year, we were focused on assets between $3 to $5 million. This year, we're focused on assets between $5 and $50 million. And starting Q1 of next year, the assets that we are listing are between $50 million to $175 million each, right? So more and more institutions are adopting towards commercial real estate as well.
Got it. And maybe to kind of roll back to some of the points you just made on like thinking about like how do accountants and administrators, how are they getting comfortable? Like what stage are they in? Like when you talk to your accounting firm, major top 4 firm, or your smaller firms in terms of marking the books on a regular basis, or just also the administrators, like what stage are they at in terms of understanding tokenization, using tokenization? Maybe Sid and then Sam, and then everyone can kind of touch base on there, but like where are the people that kind of used to do this? So they were accountants and administrators and custodians. What's their role now, and how are they getting comfortable? What stage are they at? Like what inning are we at with that?
Yeah, I can jump in
Not
on this
sure.
one. I can jump in on this one. So, we've been in very close contact with Deloitte throughout this process. And at the end of the day, we're not looking to replace those parties, right? Blockchain does not replace those parties. What they do is they enhance their usability. They make their job more efficient. They remove the friction. If anyone's been through an audit, they can tell you the horror stories of literally pulling out files for months at a time, stacking them on a table, and having a full team ready to run around the office getting missing pieces. But with what blockchain does is creating that audit trail, right? It's connecting all of those parties together. With Invenium as the pipes to the system, what we really do is by actioning the data, we really do provide that audited, ability of data, right? It's accurate, so you don't need to check anything. Where it came from, so you don't need to check anything. The source documents are linked, so that auditor can click through and see what they want, how they want, when they want. That is, to me, the overall. People say, what is blockchain doing to real estate? Blockchain is creating efficiency in one of the most inefficient marketplaces by connecting all of these silos, right? Getting away from the siloed off industry and bringing them together so that everyone can read the same data at the same time and come up with their own conclusions versus waiting for every department to put their stamp or download and upload and process, right? It's an automated process. So everyone's seeing the same thing at the same time.
Right. And Sid, did you want to add something to that?
No, agree with most of it. Only thing is that, yes, there are blockchain initiatives. Means we have a very different, more conservative approach, which would want to replace functions like paying agents, verification agents, and they call it disintermediated systems. We believe in efficient intermediation. As far as the accountants, rating agencies, those kind of intermediaries are concerned, Sam is right. It makes their job more efficient, but they would also have to evolve because some of their revenue models would change. For example, they are involved in due diligences. In structured finance, every time a transaction happens, you do a re-DD on the same loan pool. Now the due diligence will happen once. You can't keep making revenues by doing due diligences on the same pool many times. So they benefit significantly, as Sam said, because everything is recorded, easily available, and immutable. You can trust it inherently, but the revenue models for them also will have to change.
Great. Well, I'm going to jump down to question 11 because I know a lot about Bitcoin mining, and I talk to miners. I know about the machines and blockchain, and so I know that's the Bitcoin network, but blockchain's different. And so maybe I think Mohsen and Sid both mentioned Avalanche as a system. So the question I had was, what blockchain is your system on? Who pays to keep that system up and running? Like, obviously, we kind of know a little about the incentives, but maybe you guys can give us more detail, like how the blockchain that your system is on, how it really kind of works, and where are the incentives to keep it working.
My perspective on that question, I'll give you a straight answer to that. We're currently built on Avalanche. Who pays the fees? Accrue enables every user to pay their gas fees without any friction, without any hassle, and without them even realizing that they're paying it. And that's where we're building the user experience piece into it. But there's a longer piece to that answer as well, right? So it doesn't matter what blockchain you're building on. It's about what efficiencies it's adding into your system. Think of it as this. Back in the 90s, we used to go on the internet to look at this really cool website, and that website would do the function for you. Now a website is just a website. It's not built using HTML. Well, it's still built using different code behind it, but it's not, you're not coding in every little piece into it. You've got tools where you can build it out fairly quickly. You want to get more complex about it, you can. It really streamlines. You've got to streamline the entire user experience from it for it to get true adoption on it. And blockchain should truly, in my opinion, be a general purpose utility, whether it's the internet, whether it's electricity, to power bulbs or whatever else it may be. And that's how you get more adoption out of it. Sorry, it took a little bit longer than a quick answer that you were looking for, but those are my 2 cents.
No, that's good. And Sid, do you have anything to add around Avalanche and how you guys interact with it?
Yeah, so we are on an Avalanche subnet. And the reason for that is, we want every single node to be hosted within the United States, all data to reside within the United States. Because it's on a subnet in a permissioned environment, we choose all validators. So all validators are US residents or US entities. We can enforce.
What's a validator, Sid?
Okay. Yeah.
What's a validator?
Sorry. Okay. Yeah, I should have. So validators are people who are verifying transactions that are happening on a blockchain who get incentivized. So I think one of the earlier questions was on Bitcoin. So Bitcoin, the validators are in a way the miners. In Ethereum, there are people who stake, who in these public blockchains can be anybody. You can stake and become a validator. Because we run a permissioned environment, we choose people who can validate. And as I said, that we can impose like FINRA certification requirements, etc. So we have a very, very permissioned environment. And because Avalanche provides, we use it. So our use case to that extent may be slightly different. So means our deals are not publicly available. Means even the investors, issuers, anybody who's coming into our system are people who we allow to come onto our subnet.
Okay. All right. Why don't we get into some specifics around, we're a little, trying to keep on time here, applications to real estate. And so I'll give Mohsen a couple minutes to talk about that. And keep in mind, I'm getting a lot of questions in the chat. And one question is, have there been cases where real properties were tokenized? And I think the answer is yes, but I'm sure Mohsen can give a lot of color on that. And could real-time valuation and liquidity be achieved across new construction real estate projects? So that's, it's kind of some interesting questions coming in through the chat. But Mohsen, we wanted to, give you a couple minutes to talk about, how we apply tokenization to real estate, like when we get into some details, and then Sam kind of, give us, more background as well, like, and feel free to regarding real estate opportunities.
Yeah, anything can be tokenized at any given point in time. It's about the value that gets added onto it, right? I could pick up my phone and today I can decide I want to create tokens against it. What's the value out of it? Nothing much. What's the legal structure behind it? That's all of that kind of adds into it. When you're talking about tokenizing real estate, you've got to be very careful on how you're tokenizing it. And there's the right way of doing it. And then they're saying there's the vanity metric aspect of tokenizing real estate as well, right? When I say that, I say it in this perspective. The first asset to be tokenized was in 2015, which was tokenized by Meridio. They transacted a single token, a single ERC20 token, like an Ethereum coin, for transferring the entire asset capital stack from one person to the other. So from the same owners, from one wallet to the other. That was the novelty aspect of tokenization. The first truly institutional asset that was tokenized was the St. Regis Aspen. That was the vanity metric behind it. Hey, we're using blockchain to do real estate. Those are just LP interest sold using Reg S outside the US for the most part, and just represented using tokens. No real efficiencies are brought in the system with that. They don't lead to easier liquidity because they're blockchain tokens, or they don't lead to better data because there's no data connected to those tokens in any way or form. They don't lead to anything else, right? So when Accrue does real estate tokenization, we look at it as a full life cycle solution perspective, right? So when you're fractionalizing an asset, you've got to have the same approach as you are when you're looking at a traditional real asset as well. You've got to underwrite that asset. You've got to get all the baseline information in place behind it. Who's doing it? What's their experience? What are the projections on the data? What are the financials like? What kind of background does the developer have, and what does the market look like in the neighborhood? From there on, it goes into an initial offering where once the due diligence is completed, valuations are agreed upon. We do the initial offering piece, or where we IPO the building per se, and we sell a minimum or maximum piece and what the asset owner wants to sell out of the equity stack in the deal. As soon as that completes, SEC mandates a 90-day hold period based on very specific exemptions and no action letters that we utilize on our platform. And then your secondary market opens up. Your secondary market is where people can buy, sell, and trade these. People in real estate have created a lot of ATSs where they're trading using a bid-ask matching service. You've got companies doing that using blockchain, without using blockchain. But the problem with that is real estate is an OTC product, right? So their price discovery is a key piece behind it. It's not something where you can just have a traditional bid-ask matching piece kind of come to a solution with it. And that's what Accrue is solving for, right? That's what happens when someone wants to list their shares on the secondary market for trading. They list it at whatever list price they want, even though we're providing quarterly appraisals on these assets and quarterly market price guidance on every token. You list that token, and the following person can come in and they can click on the eBay buy now button, or they can counter you back with a different number on it. That's what brings in the efficiency and the liquidity in the real estate transaction process. Now, more importantly, on the back end, once the deal's all done, someone needs to do the distributions on it. Someone needs to do the K1s on it, or the tax documents on it. Someone needs to do the waterfall management on it. And that's where we really add the efficiencies in the system. It's not that we're replacing your CPAs for creating those K1s, but imagine if one share sells twice a day for these tokenized assets. It's not happening today, but eventually. That means you need to issue 735 K1s, odd K1s at the end of the year, or 730 odd K1s at the end of the year against that single share. And if it's a $10 million asset with $1,000 share price, you're talking about 735,000 different or 7.35 million different K1s to be issued. Practically just not possible, right? Today, crowdfunding creates 50 K1s for each entity, and that's got CPAs really riled up on how difficult that is. How do you track those ownerships when it's trading over a period of time? That's the efficiency that the accrue system brings in. We take the 1065, we take the Schedule K from the CPAs, and then the system churns out the K1s for each individual investor. Similarly, when you want to do distributions, you don't have to put in every investor or update every investor's ACH information every time. Just say this quarter's distribution is $1 million, and you click, it automatically distributes to every investor in there. Really adding a lot of efficiencies in that investor management piece, the compliance side of things, looking at subdoc management and ensuring accreditation statuses, because our offerings are all Reg D 506C offerings. So we have to ensure that these are verified accredited investors that are buying, selling, and trading these. In the SEC states that accreditation status is only valid for 90 days. So every 90 days, we have to ensure that the investors are re-upping that accreditation verification.
Yeah, my CPA loves that. My CPA loves me him writing a letter every 90 days. I got a good question for you, Mohsen. So sorry to interrupt, but I think this might be, so one of the, actually it's from Jack. He says, what happens when a general partner decides to sell his majority part of a fractional property? Must the platform investors be dragged along? Can they hold?
I'm sorry. I missed the last part of it.
So when a general partner wants to sell his majority part of a fractional property, must the platform, I guess the smaller investors, be dragged along, or can they continue to hold their tokens?
Yeah, look, that's the beauty of the system, right? There's liquidity available for whoever wants it whenever they want it. When you fractionalize an asset, when you tokenize an asset, and you bring it on the accrue platform, it's up to the GP and the LPs as to how much of it do they want to sell upfront, how much of it do they want to retain, and whatever aspect they want to, and for whatever time period they want to hold it for. So if I'm an LP in a deal and I say I don't want to sell any of my LP interest, I'm going to hold it for another 2, 3, 4 years, I can continue to do that. As opposed to if I'm a GP in the deal and I say, yeah, I want to liquidate 50% of my equitable interest in there, as long as my loan covenants on the outstanding debt allow me to do so, there's nothing that stops them from selling those assets. And that's the biggest thing. It's the ability for everyone to sell their shares or their tokens anytime they want, not just in the initial offering, but also on the secondary market, right? And before the secondary market opens up for every asset, there's like a 90-day cool-off period only, not much more than that.
Great. All right. Thanks that's a good overview of high level and some details on the application of real estate. Sid, why don't so Mohsen's talking about specific commercial properties, like here's a building, it's rented up, I'm going to fractionalize the ownership of it. And that's the work that Mohsen has been talking about. Maybe you can give a little insight about how tokenization helps structured finance in regards to, I guess, the administrative side, which I think, you've been pretty active, and then also on distribution side, capital raising.
Sure. Are we using the slides, Paul, or
sure. Yes.
No, I'm fine either ways. Yeah.
No, I'll bring them. Sorry, and then we'll.
No, that's
there we go.
Yeah. So I just picked these couple of slides just to explain that, for example, if Accrue would do this without the Invenium data, means how much value would come. And a lot of blockchain initiatives generally have just focused on tokenization. Even today's session means a lot of questions revolve around tokenization. But tokenization of a final instrument in itself means very little, because the whole complexity lies in how they are being administered behind the token. For example, in the crisis, if all the final CDOs were traded as tokens instead of being traded as paper-based contracts, would it have made any difference at all? And the answer is no. So one thing we need to bear in mind is that the value of blockchain really is that how much credibility you try to bring onto the blockchain on what is behind that token. Just move to the next slide. And that's why we have been in the space for 4.5 years now. And we did not tokenize anything for 4 years. For 4 years, we have been building the infrastructure for structured finance. So the whole idea has been that we are not bringing the asset or the money itself to the blockchain, but we are bringing the data about the asset to the blockchain. So for asset-backed and mortgage-backed securities, we are bringing the data about the loans and the security on the blockchain, so that the verification agent, who's actually as a custodian verifying those loans and certifying, the paying agent who's running all those models based on the indenture agreements to make the payouts, all that function comes onto the blockchain. And there we now have all the complex deal structures. And what this has ensured is, so this is nothing to do with tokenization yet, but still benefits of blockchain. So currently, Paul, you've been in this industry for long, so you know that what happens is that month end, next 15 days, people just reconcile data, and the final report is available to an investor by 20th or 25th of the subsequent month, and that is when the payments are made. Now, it is easy to say that it is 20 days after the month end, but it's actually 55 days after an event that would have occurred on the first day of the previous month. So a collection that is made on 1st of October, the investor gets that money on 25th of November. An event that happens on 1st of October, an investor gets a report in a PDF on 25th of November. Now, just putting the data actually completely streamlines this and makes it real time. Just go to the next slide.
Sure.
Yeah. This is slightly complex, but this shows that means what all is involved in tokenization, at least in structured finance. So starting from kind of bottom left, so issuer comes with a pool of loans. Now, these loans are not on blockchain. So there are blockchain native assets and there are assets off blockchain, like real estate. Means the building is not on blockchain, the building is off blockchain. Similarly, 99.9% of the loans today are off blockchain. So a custodian has to verify and certify. Once they are certified, we convert each loan into a token. The underwriter, the way traditionally underwriting has been done, underwrites, and then we create investment tranches, which people then invest into. And hence, from the issuance to the investment part becomes completely digital with real-time settlement. And once collections against those loans start happening, then because the terms of the original agreement, based on which each tranche holder needs to be paid out, are coded as software programs, which is glorified in blockchain lingo as smart contracts, which has nothing to do with being smart or contract. There's simple software programs running on blockchains. They kick in, they do the calculations based on which the payments are made. So it's basically what was happening manually, as I said, across 50 days is real time, completely digitized. So yeah, so that's kind of how it works in structured finance.
Got it. Got it. In regards to data, Sam, maybe, you can kind of give us like Sid was talking about, I used to tell people like the securitization market, has 12 heartbeats a year, right? It's just like you get that file in and that's, from an internal standpoint of the deal, that's it. Like you get obviously there's outside occurrences that happen in the economy. And yesterday we had an interest rate rise, But, from the securitization itself, you have 12 heartbeats a year. But now, like, I guess we have two things. We have real-time data from borrowers, possibly, and maybe Sid can touch on that, from the servicer, but also from other sources. So maybe Sam, you kind of give us an insight in terms of real-time data for either real estate or structured finance, and how that kind of plays in and fits in with tokenization.
Yeah, so we have both. We handle private credit, private debt. We also, handle, the equity stacks on those as well. So, we have numerous lenders out there that, are on our platform and providing us the data on their loans. Loans are based on, assets, although there's, some criteria, the DCRs, the rates, as you have it, some pay down requirements or whatever the case may be. But, at the end of the day, it's still data that's linked to an asset. Whether, you own that asset and you're the GP trying to determine the value of the cap stack, or you're the lender that's holding that piece that is still backed by the asset and the market. Data is data. Structured data is structured data. The better the data is, the better the value is. And therefore you always should know not only what the value of the cap stack is, but what the value of the debt is. And it's not really different than what's been done for years in the finance arena. On the debt, you have tranches of single family home debt, all that get packaged up all the time, right? I mean, that's just, you have secondary market trading on debt that happens all the time. That's what the initial loan is based on. That's why there's the so-called LTV benchmark, because that is what they can sell it for in the secondary market. The difference here is that the data that you're getting is real time. The data you're getting is verified. The historical data trades, travels with the token. So if you're a token holder that purchases a token, in the 10th year, you're going to see the historical data that has always been with that asset, regardless of what point in time that you bought it. Everyone's got a different, investor criteria, right? Some guys really, if you take a new construction building, because that was brought up before, if shovel in the ground, that token's worth $1. Stabilized, built, leased up, that's worth $10. There's an investor out there that really wants the risk, right? So he's going to take that token throughout the process from 1 to 5. Then you have, the investor that's, let's just call it, doesn't want the risk. They feel the risk's been mitigated, but there's still some upside in it, right? This is maybe the 15 guy, right? Not the 20 to 22 guy. And then at the end, you have the insurance companies that are yield buyers, right? They're looking to the 4 to 6%. And so because of that, new construction is a great version of tokenization. I think it's probably one of the better versions of tokenization out there. But the beauty of it all is the efficiency that the blockchain creates and allows for this to be a frictionless transaction, a decentralized investor base, right? Anyone can invest in any market so long as they, fit the criteria and the rules and regulations that have been set forth, whether it be Accrue or others. The rules are the same. Accredited investor is accredited investor. And so as long as you follow those steps, it just really creates a much more efficient marketplace.
And if there's corrections to data, like let's say in the securitization market, from time to time, there may be some correction on a loan, or years ago you would see like there could be corrections, and like basically a new PDF would be posted on the trustee's website, and then the old one was gone, right? And so, ideas of the correction happened, but then you'd have to figure out, oh, like I had to reverse a payment now, or the DTC had to I had to send money back, or they netted out of the next payment. Like that's something that stays with the property of the security as well, right, Sam? That like corrections are kind of documented.
Yeah, I mean, like I said, value's value. The fact that you're getting the quarterly valuation from a third party provider, that's the value. So, listen, it's just like any, other security. The only difference is this is a real asset backed by real data, right? So there's this huge, we call it the cliff between private and public markets. What's the difference? The difference is data, right? The difference is.
Yeah, I like that. Yeah, that's a great point. The difference is data between the public and private market. I got a couple of questions on the chat, so let me get to those questions and then I'll try. And this is probably for anyone. This is a good one. This is from one of my old colleagues. He said, are these tokens and their tradings subject to any securitization regulations?
Absolutely.
Yeah.
That's what I'm going to say. Look, tokenization does not mean there's no regulation required. Tokenization does not mean we're running away from regulation or anything like that. Securities law is securities law. You've got to stick to what is out there. You've got to stick within current regulations and whatever exemptions you're working under, or whatever offering structures you're working under. Every single rule on that applies, and compliance is a major piece to it. So every offering on the Accrue platform is a Reg D 506C offering. So some simple compliance like AML and KYC obviously is there across the board, but those accreditation verifications every 90 days for people to participate in every transaction, for making sure that those subdocs and those are all signed off on happens through our identity token, because we do the third-party verifications on that front. Similarly, on the secondary market trading side, ensuring that after the initial offering, there has been a 90-day cool-off period for that offering. And then that secondary market is only open to the active accredited investors on the Accrue platform. So all of that is securities law compliance that comes in, because post that initial 90-day cool-off period, now tokens can be traded day in, day out, right? Between every asset owner and between every investor within an asset and new investors. So you've got to ensure that the compliance piece kind of comes in on it. So securities law is of utmost importance and should not be avoided in any way or form if you're trying to tokenize an asset. We're all about regulation first and ensuring compliance throughout our process. In the last 4 years, that's all that we built our product around, is compliance.
And Mohsen, does tokenization change anything in the piece of real estate?
I'm sorry?
Does tokenization change anything in real estate investment?
Look, the legal structure remains the same, right? It just creates the efficiencies in the system. It's not that you're buying a different membership interest unit in an LLC. You're buying the exact same thing. It's not that you're buying a different kind of real estate asset. You're buying the exact same thing. What it does is it creates the efficiencies, but because now you have better data with real-time data coming in from those assets, like what we use with Invenium and our integrations. That real-time data leads to real-time valuations on these assets as well, which then leads to better decisions on the investment side. It leads to better reporting on the other side. So it's just the efficiencies that it creates in the business.
It's like having your cake and eat it too. And then on top of it, it provides, it's investing in real estate with that optionality of liquidity.
Liquidity is the holy grail, right? That's something that really changes in the entire ecosystem. Real estate has traditionally been extremely illiquid to a point where it really, your GPs are paying a premium to get LPs on the platform, and they're they have to pay very high fees in the form of preferred returns, in the form of whether they're accrued or whether they're kept current, and different kind of terms on those end. And when you're fractionalizing it and you're granting access to a much larger audience on it, and you're enabling people to write $10,000 checks, $20,000 checks as opposed to $100,000 or $500,000 checks, you really get the benefits of that in there as well.
Yeah. Hey, Mohsen, we want to get to a couple more questions.
Yep.
I think there's someone on the line that just wants to unmute themselves.
Yeah, anyone can unmute yourselves.
Yeah, we have some questions, so I'll let some people kind of ask questions.
Yeah. Just as a reminder, we have a hard stop at 12, so we'll wrap it up to the top of the arc, but keep it going.
Yeah,
for it.
it's me, Paul. Am
Great.
I audible?
Yeah, we can hear you. Go for
Yeah,
it.
am I audible? Yeah. Thank you. Thank you, Mohsen, Sid, and Sam for the wonderful session. It's really useful. And basically, this is Satyanarayan here, and I'm basically a blockchain business consultant. And apart from that, I work as a deputy vice president with HDFC Bank. I have two queries with the audience. One is like when you do a tokenization on the real estate, and if the asset gets appreciated or depreciated for some reason, how these tokens get modified? Because when you put it on blockchain, it's become immutable. So what exactly your thought on that process? What when you put saying the tokenization? And one more thing is like the other thing is Sid has a fantastic point on those, the way the smart contract has been discussed as such. And I think the smart contract has been hyped a lot, where people are trying to think that blockchain with smart contract is something which needs to be necessary. But with the current technology, we can also create a blockchain without without having the smart contracts if you have the inbuilt parameters being built on. So that is one more take. And apart from that, Mohsen, one more thing I would like to say is blockchain plays an important role in terms of if you can't able to identify which blockchain that you have put in, sometimes there will be some type of hacking and security.
Yes,
we got let's go to the answers.
Yeah.
So I'm gonna get back to you with a few with the answers on what you're talking about, right? When you're putting real estate, when you're fractionalizing real estate and you're tokenizing real estate, what you're putting on chain is what I said earlier. You're taking the Schedule A for a membership, for an operating agreement, and you're digitizing that. That's all that you're doing. That doesn't mean that you've got valuations set in immutably. You just know who the owner behind it is. You're adding that traceability and that trackability to it. That's a problem with this industry, unfortunately, and I apologize for that. Is when you get a lot of techies trying to solve a real world problem without knowing what the real world problem is, and that's what's given this industry such a bad name, the blockchain and crypto industry. Whereas, hey, we're a solution looking for a problem. If you don't understand what the industry really needs, like what Sid is doing within structured finance or what we're doing within real estate, because we come from this world, right? All that I've done all my life, all that our team has done all their lives is real estate and securities, nothing more. So we're solving problems within that and we're using the technology, your blockchain piece to it for efficiencies. Now, when you're talking about securities and blockchain and not having smart contracts, look, I agree with Sid completely that there's a big misconception on what smart contracts are. People think maybe it's a legal contract. It's not. It's just a piece of code. The way I like to explain smart contracts it's a perfectly functioning vending machine where you put in a buck and you press B1 and you're going to get that can of Diet Coke and never a can of Diet Pepsi, because that's not what you chose. If there's no Diet Coke in there, you're getting your buck back out of it. So it's that perfect piece of code that ensures if all conditions are met, the transaction goes through appropriately. And you can have multiple checks and balances in place. And they're extremely necessary for creating those efficiencies in place as well, whether it's compliance check, maximum number of investor checks, whether it's checks on the transaction ability of it with the actual amounts of if any individual investor can own over a certain point or not, and so on. So each and every aspect of that needs to be really looked at and needs to be solved for. Your last part of the question was an interesting piece as well, that people should know, because in case of a security breach or something on those lines, when you're tokenizing securities, one of the key things that comes into place per the SEC is, if you're doing self-custody, you've got to be able to have the ability to burn and reissue those tokens. And these are security tokens, right? And we do have the ability to do that. So in case, even if you do have a breach, and breaches are not usually that possible, because there's multiple layers of checks and balances when it comes to security tokens. This is not crypto where it can be transferred between any wallets. There's whitelisted wallets. There's other requirements for it. Like in our structure, we've got an identity token which needs to be present in a wallet before that transaction happens, and so on and so forth. So even if and when that does happen, for instance, if I die and my tokens need to be transferred to my kids or something on those lines, or my trust, that can be done through burning and reissuing those.
Yeah,
And
most
that's
of
why,
you're getting into the part 2. I think we're gonna have to have a part 2 on this, because we're
absolutely.
getting into detail. Sid, do you want to touch
I-
base on that too? Is it any other comments? So you were nodding, and Sam, if you have any thoughts, and then we'll kind of round it up. I think we got 5 minutes left.
No, Mohsen covered most of it. And it is true that we have to think of a technology which is facilitating the process as it exists today with regulations. You cannot create something completely new. You can't create your own laws, obviously. So it is a technology which is making it more efficient, trustworthy, transparent, but no laws change, nothing changes just because it's on blockchain.
Great.
Yes,
good,
just
Sam.
to sum it all up, I think we've all said the same thing. The misconception is that tokenization is different than investing in real estate, right? It's not. It's actually better, right? It's the next version, because it takes out the friction. It's better data. It's better value. It's more transparency. That's it. It really is that simple. If someone were to say, what is tokenization? That's it. Better data, better value, more efficiency, more liquidity. And if you think about it, because of all of that, the value of the asset, I don't want to say is more, but the value of the investment it's more valuable to invest this way than it is, just your normal, PDFs, and without blockchain and without tokenization, because of the efficiencies and the transparency and the trust that's provided by blockchain and tokenization.
Sam, I think you're doing a Papa John commercial. It was like better data, better ingredients, better pizza. Well, this is better data, better securities, or real estate opportunities. Well, we're almost out of time here, so I'm sorry we didn't get to everyone's question. I put my email in the chat again, so you can email me any questions you have, and we'll save those for the next one, and I'll try to relay.
Paul, I would just add on in the chat, we have a tokenization group on our app so that we can keep the conversation going. The deck that we just showed is there, and would advise everyone we're an open architecture community. We have interesting ideas, or like, what do you want part 2 to consist of, or 3 or 4 or 5? So, suggest a way. At 10:30 on Tuesdays and Wednesdays, we have our town hall. We sort of mix it up, or just contact Paul or me. And, this is not my platform. This is ours. It's yours. So that's just keep that in mind.
Great. Well, I'll just leave it this. I'll say have a very prosperous day. Thank you for everyone for attending. Thank you, Mohsen, Sid, Sam. I think you guys, I learned a little bit as well, and I'm sure a lot of people on this call learned a lot. And we'll see you next time. Thank you, everyone.
Thank you for having
Thanks,
us.
everybody.
Absolute pleasure.
Pleasure being there. Yeah.
Take
Take
care.
care, everyone.
Come join our 361 Firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.